Hello, welcome to part two of the chapter 14 lecture on long-term debt. In the last video, we discussed bonds and how to record bonds when they're issued at premium, a discount, or par value, and also how to amortize those bonds using the straight line method. In this video, we're going to talk about the effective interest method, and hopefully it won't be so long that I won't get an opportunity to also discuss with you the extinguishment of debt, or when bonds are retired early. So in dealing with the effective interest method, keep in mind that the carrying value of the bond has to be equal to the par value of the bond at the end of the life of the bond. So that requires that if the bond is issued at a premium or a discount, we have to amortize or slowly and systematically reduce the discount or premium over time so that it's zero, so that when we get to the end of the life of the bond, the carrying value is equal to the par value. Well, in the last video, we used the straight line method where we took the discount or premium and we divided it by the number of periods that we paid out interest. And then we backed into interest expense. Interest expense was a plug. The straight line method is fine to use unless the effective interest method measures the interest expense more accurately, and usually it does. So generally companies will use the effective interest method because it's better. But the straight line method is easier in that interest expense is the same every single period because our amortization is the same every single period. But under the effective interest method, it requires that we first find interest expense and then subtract out the cash interest payment to find the amortization, which is different from the straight line method because we find the amortization first. Then we add or subtract that from the bond interest paid, depending on whether we're dealing with a discount or premium, and we back into interest expense. So now we're working in the opposite direction. So we find bond interest expense by taking the carrying values of the bond at the beginning of the period, and we multiply that times the effective rate of interest, or the market rate of interest. So not the contract rate of interest. Remember, the contract or the stated rate is what we use to help us find our cash interest payment. So once we find our interest expense, the difference between our interest expense and the cash interest paid is the amount of our amortization. So that means we are going to be dealing with a different amount of interest expense each period. What will remain constant is the cash interest payment. So let's do this example. Keep in mind, we are using the effective interest method. So really, the only thing that's changing is how we calculate interest expense. So we have Evermaster Corporation issuing $100,000 of 8% term bonds on January 1st, 2020, due on January 1st, 2025. With interest payable each July 1 and January 1, investors require an effective interest rate of 10%. Calculate the bond proceeds. So looking at this immediately, I know that this is issued at a discount, not just because it says it right here, but because the contractor stated rate of interest is lower than the market rate of interest. The market sees this bond as a risk, so they're requiring a higher rate of interest. We can find the proceeds because we weren't given a percentage of par this time. So we can find the cash proceeds by determining the present value of all of our future cash flows. And all of our future cash flows involve the cash interest payments as well as the par value. So to find the present value of the par value, we're going to use the table 6.2 that gives us the present value of a single sum. That gives us a present value factor of a single sum. And we end up using a discount rate of, let's see, interest is payable 2 times a year. So we cut the discount rate in half, or in other words, we cut the interest rate in half, and we increase the number of periods. Oops. So we multiply the number of periods by 2. So this is a 5-year bond. We multiply it times 2. So that means we're dealing with 10 periods at an interest rate of 5%. Not 5 periods at an interest rate of 10%, because interest is paid 2 times a year. So you have to take that into consideration. Now, we also find the present value of an annuity And that is for the present value of our interest payment. So we first calculate our interest payments by taking the 100,000 times 8% times a half. That's where the $4,000 comes from. And then we multiply that times the present value factor of an ordinary annuity, again using 5% and 10 periods. So when we add that together, that gives us our cash proceeds, and we see that the cash proceeds are less than the par value of the bonds. The difference between those two represents, and when I say those two, I mean the proceeds from the sale of the bonds and the maturity value of the bonds. The difference is the discount on bonds payable. So all of this is in essence a review. I showed you this in the most recent video that you watched. But here is the new part, because now we are required to prepare an amortization schedule that shows us our interest. The amount of cash that we pay out in interest doesn't change. It remains the same every single period. We found it once, it's $4,000 until the bond matures. But the interest expense is dependent upon the carrying value of the bonds at the beginning of the period. And we know that the carrying value of the bond slowly increases because at the end of the life of the bond, the carrying value has to be equal to the par value. So that carrying value when bonds are issued at a discount is slowly increasing because we're amortizing the discount on bonds payable. So we find the interest expense by taking our market rate of interest, which was, I forget what it was, I think it was 10%. Yes, our market rate of interest of 10%. And we multiply that times the carrying value of the bonds. But then we also have to multiply that times a half, because remember, interest is paid out 2 times a year. So when we do this 92,278 times 10% times a half, that's where the 4,614 comes from. The difference between the interest expense and the cash paid is the amortization of the bond discount. Now keep in mind that interest expense, or the amortization of a discount, increases interest expense over the life of the bonds when you're dealing with a bond discount. In other words, you're going to have a higher interest expense than you are going to have cash paid out, because the bondholders require a higher interest rate, and they do in effect earn it. So here is the key to the effective interest method. Once you're done with one period, you do have to find your new carrying value. When we reduce the discount on bonds payable, it ends up increasing the carrying amount of the bond. So we add in the amortized discount to the previous carrying value to find our new carrying value. So you can go back and double check this, but this 92,892 is the 92,278 plus the 614. So that when we come to the next period, we're going to multiply this 92,892 times 10% times a half, and that's going to give us our interest expense. We subtract out the cash paid, that gives us the amount of amortization that we need to record. So notice that our numbers are changing every single time. My interest expense continues to increase. The discount on bond, the amortization of the discount on bonds payable is increasing as well, and the carrying amount of the bonds is increasing as well. But the key to the effective interest method is calculate that interest expense first using the beginning of period carrying value of the bond. So when we do our first entry for issuance, that looks the same as what we saw before in the previous video, same as what you learned in accounting 2. The method of amortizing the discount only affects the cash interest payments, or the entry for the cash interest payments. We now have our interest expense that will not be the same every single period. We also credit discount on bonds payable for the amount of the amortization that we found by taking the difference between the interest expense and the cash paid, and then we credit cash. And on December 31st, the interest payable is now that $4,000, but my interest expense comes directly from that schedule. And that's found again by taking the carrying amount times the market rate of interest times a half. And the difference between the interest expense and the cash paid is the amount of amortization that I need to record for the discount on bonds payable. Now, when it's issued at a premium, things are sort of in reverse in that interest expense will be lower over the life of the bonds because the bondholders are earning a lower rate of interest. And we can see this clearly by looking at the contract rate of interest of 8% versus the market rate of interest of 6%. So we still find the present value of these bonds in the same way. We're using the present value of an annuity, an ordinary annuity for the cash interest payments. And don't forget to cut that interest rate in half and multiply those periods by 2 because we're dealing with interest being paid 2 times a year. And we're also dealing with the present value of a single sum here for the maturity value or the par value. So once we find that, we add those two together, and we see that this time the cash proceeds are higher than the par value. And that's okay. It just means the bonds are issued at a premium. That premium will need to be amortized. Now this, if you want to look at these tables, you can, but it just shows you how we're coming up with these factors and which tables we're using from your textbook. But we learned that in chapter 6, so we're good with that. But we still need to prepare our amortization schedule because interest expense under the effective interest method will be different every single period. This time, interest expense will decrease. The amount of premium that we're amortizing is increasing, but the carrying value is decreasing as well. And we expect the interest expense to decrease because interest expense is lower over the life of the bonds when bonds are issued at a premium. The bondholders are earning a lower rate of interest than what we're paying out. So when we calculate the interest expense, we do it in the same way. We're still taking the carrying value of the bonds and multiplying it times the market rate of interest and then times a half. The difference between the interest expense and the cash paid is still the amount that needs to be amortized, but it is the amortization of the premium. This is where it gets a tiny bit tricky because instead of adding this premium to the carrying amount of bonds, it will be subtracted because when we do our entry, we're going to end up debiting premium on bonds payable, and that's going to lower that premium on bonds payable, which will in effect lower the carrying value because that is an adjunct liability account. So notice that the carrying value continues to get smaller so that at the end of the life of these bonds, the carrying value is equal to the par value of these bonds. So when we do the second payment, we have to take that carrying value and then again, multiply it times the market rate of interest. But just make sure you're taking into consideration the amortization of the premium because it is the carrying value at the beginning of the period. So when we do our entries, the entries are the same for the issuance that we saw in the previous lecture video. You're still debiting cash, bonds payable is still valued at par. And to make our journal entry balance, we have to credit premium on bonds payable. What changes is the numbers for our entries for the semi-annual cash interest payments. So we debit interest expense for the number that we have calculated. Cash still gets credited for the $4,000. And now we need more on the debit side. And the difference between those numbers is the amortization of the premium. Now, if the financial statements happen to be issued at a date other than a semi-annual interest payment date, then you do have to prorate the premium by the appropriate number of months to arrive at the correct amount. So we still amortize the premium on the semi-annual interest payment dates, but to make sure our financial statements are accurate, we do need to prorate the premium if the financial statement date happens to fall on a date that is not an interest payment date. I'm sure that companies take that into consideration. They try to make sure that there is some consistency, but there may not be for whatever reason. So that's something that you may have to watch. But here's the entry for that additional interest that needs to be accrued as a result of the financial statement date being different from the interest payment date. So in dealing with a bond discount, remember it is a contra liability account. It's linked with bonds payable, but it does have the opposite balance. And because it's linked with bonds payable, the combination of those two, they help me calculate my carrying value. Bond premium works the same way, only it's an adjunct liability account. So it does have a normal credit balance. And this time I'm adding that to my bonds payable to give me the carrying value, whereas with the discount, I'm subtracting. All right, let's move on to the extinguishment of debt. An extinguishment of debt is just a fancy way of saying the debt is being paid off. Now, here's this term economic substance again. And you may remember this from Intermediate 1, where we were talking about exchanges of assets, where you trade in one truck for another truck, and whether or not the transaction had commercial substance that determined whether or not you recorded a gain or a loss. Well, that whole idea of economic substance comes back into play again. So if a company holds the bonds until they mature, we don't really deal with any gains or losses at all, because the company is not in a better or worse off economic situation. They're simply paying off debt that they said they were going to pay off. At the end of the life of the bonds, the carrying value is equal to the par value, so there is no gain or loss to record. But what happens when the company pays off the debt before it matures? And there could be a premium or a discount that we need to take into account. There are also some other things that we may need to take into account. If it is a callable bond, there may be a call premium, which is like some extra money that the corporation will give the bondholders because they're paying the bonds off early. So whatever the corporation pays before maturity in order to retire a bond, that term is known as the reacquisition price. We have to compare that reacquisition price to the carrying amount of the bond. So that means we're looking at any unamortized discount or premium, and there could be a gain or a loss in that situation because the debt is being retired early and the premium or discount is not fully amortized, or if the corporation ends up paying more because they're retiring the bonds early, then that corporation is in a different economic situation. The transaction has economic substance, so there is a gain or loss that we need to report. So just like this is very similar to when you're disposing of assets and you have to update depreciation, you have to update amortization as well. So update that amortization first and then find that new carrying value and then compare that to the reacquisition price to determine if there was a gain or loss. So what do I want you to know from this? When debt is retired early, there could be a gain or loss. Pay close attention to those amounts in terms of the reacquisition price and the carrying value of the bond. So let's say this example. We have General Bell Corporation issuing at 95 bonds with a par value of $800,000. So I know immediately these bonds were issued at a discount. They're due in 20 years. 8 years after the issue date, General calls the entire issue at 101. So they are going to pay 101% of par value. That is the reacquisition price. So pay close attention to that number. And they cancel the debt. At that time, the unamortized discount is $24,000. And we need to compute whether or not there's a gain or loss. So the reacquisition price is the call price, that 101. So put a percentage behind that, 101% of 800,000 is the reacquisition price. The carrying value of the bond, so the amortization of the discount was already updated for us. So we know that the unamortized discount is 24. So we're going to subtract that from the maturity value or the par value of the bonds. And that tells us that we're carrying the bonds at 776. The difference between 776 and 808 is the loss on redemption. So let's make sense out of this. If we're saying this debt is worth $776,000, but we have to pay $808,000 to get rid of it, then we're saying we have to pay more than what it's worth, which represents a loss. If we had to pay less than what it was worth, it would be a gain. But in this situation, it is a loss. So we record this as such. We take bonds payable off the books, we take discount on bonds payable off the books, and we record the additional loss on redemption of bonds that would show up in the other revenues and gains, other expenses and losses section of the income statement. And of course, the cash that we are paying out as the reacquisition price. So just keep in mind, you may have to deal with some losses or gains when debt is extinguished. Now, I decided to make this video really, really short because the last one was way too long. So hopefully this helps to provide you with some momentum. Join me for the next video where we will be discussing how to account for long-term notes payable, as well as some presentation and disclosure issues as they specifically relate to long-term debt. I appreciate your time and attention. I hope you have a wonderful day.